This is one of the most important charts for the overall market. The 10-year Treasury Index, which shows the yield of the 10-year, is extremely important. Here are 4 things you need to know about the 10-year Treasury. The first thing is technicals. This chart is the 1-year daily chart. And as you can see, we have broken out, we passed resistance, and the uptrend has continued. The move in yields has been incredible. This chart is the monthly chart, and it shows all of the charting history for the 10-year Treasury yield. As you can see, that 4% was a major resistance. And like I said earlier, we are now higher than that number. The second thing with the 10-year Treasury that you need to know is market competition. When yields or annual returns on bonds increases, they become more attractive to investors, which in turn takes money away from the stock market. Bonds are essentially risk-free investments with essentially guaranteed returns. Stocks, on the other hand, have more risk associated with them, and they can actually post negative returns. With treasury yields above 4%, it might not be a bad idea to lock in some of those gains for a couple years. So some investors might be moving their money from the stock market into the bond market. The third thing you need to know about the 10-year Treasury Index is the impact it has on corporate valuations. A higher yield on the 10-year represents a climate where the cost to borrow money is much higher. This hurts traditional methods of valuating a company, such as a discounted cash flow analysis. Essentially, the price you're willing to pay for future growth is less in a high rate environment. The fourth thing that you need to know is the impact the Federal Reserve has on the 10-year Treasury. Right now, the Federal Reserve is doing 2 things, and both are making it easier for the 10-year Treasury to continue to go higher. The first thing is they are increasing the federal fund rate. The federal fund rate is an overnight rate set by the Federal Reserve. The higher that rate goes, the higher the rates will go across the yield curve, which includes the 10-year Treasury. The second thing they are doing is quantitative tightening at $95 billion a month in treasuries and mortgage-backed securities. In quantitative tightening, the supply of treasuries goes up. This makes it easier for the interest rate on the treasury to go up as well. Unfortunately, those 4 factors we covered in this video are headwinds against the overall stock market. And that's why it's super important to follow the yield of the 10-year. Knowing this well can help you position yourself correctly for potential market reversals and for continued momentum trades. If you are interested in live trade alerts, you can join the private Discord. Link is provided in the bio. Just this week alone, we have had 2 trades that have been multi-baggers posting more than 100% returns. We look for trades that are high risk to reward ratios, ideally 10 to 1 or higher. That's a wrap. Hit that follow and I'll see you on the next video.